Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Clp Holdings Limited annual report. Clp Holdings Limited offers a diverse range of businesses and services across various regions. The company's primary focus is on the generation, transmission, and distribution of electricity through multiple sources such as coal, gas, nuclear, wind, hydro, and solar power. This includes providing pumped storage services to support energy needs. In addition to its core business, Clp Holdings Limited also offers retail services for both electricity and gas. The company's expertise extends beyond energy generation and supply, with a focus on infrastructure solutions and property investment activities. Its operations span across Hong Kong, mainland China, India, Thailand, Taiwan, and Australia, making it a significant player in the global energy market. The company's extensive portfolio of services reflects its commitment to meeting the evolving needs of its customers and contributing to the development of sustainable energy solutions. With over 120 years of experience, Clp Holdings Limited has established itself as a trusted provider of energy-related services and infrastructure solutions. Clp Holdings' stock price has seen a significant increase of over 20% in the past year, driven by several key factors. One major contributor is the company's decision to raise its dividend payout despite a decline in overall profits. The increased dividend, coupled with the bond-like appeal of utility stocks in today's low-interest rate environment, has made Clp Holdings an attractive choice for institutional investors. The stable cash flows and high dividend yields offered by utility stocks like Clp Holdings have led to a surge in demand, pushing the company's stock price to historic highs. Additionally, the company's strong performance in its Hong Kong operations, with operating earnings increasing by 7% year-on-year, has also contributed to its success. Furthermore, Clp Holdings' focus on non-carbon assets and renewable energy projects has resonated with investors seeking sustainable and environmentally friendly investments. The successful commissioning of wind farms in China and India, as well as the sale of its coal-fired asset, demonstrate the company's commitment to reducing its carbon footprint and aligning with growing investor interest in renewable energy. Overall, Clp Holdings' strategic decisions and strong operational performance have driven its stock price increase, making it an attractive option for investors seeking stable returns and a sustainable future. Clp Holdings Limited maintains a market capitalization of $185 billion, broadly in line with the industry peer group. Clp Holdings Limited trades at a higher price-to-earnings ratio of 18 times and a higher price-to-book ratio of 1.72 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 53% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 7.16%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for Clp Holdings can be categorized into several key areas. On the growth side, the increasing adoption of renewable energy sources such as solar and wind power is a significant driver, fueled by feed-in tariffs, FITs, and other incentives. Additionally, subscription-based models for energy services, known as energy as a service, are contributing to revenue growth. Flexible capacity, which balances the intermittency of renewable energy sources, is also driving revenue growth. On the decline side, payables under the SOC agreement are a major driver of revenue decline, along with variations in fuel costs compared to standard costs, and a decrease in system maximum demand. It's worth noting that while some sectors such as transmission, distribution, and retail have experienced a decline in revenue due to changes in tariffs and fuel costs, others like renewables revenue have been affected by specific events such as the acquisition of CLP headquarters. Overall, renewable energy, energy-as-a-service models, and flexible capacity are key drivers of revenue growth for CLP Holdings. The net income of the company experienced a marginal decrease, with one instance showing a specific decline of $740 million. This reduction was attributed to a combination of factors, including a 5% drop in long-term gross margin and a 1% decrease in annual customer account growth rate. Profit margins also underwent a change, with some instances not explicitly stated or mentioned. However, it is noted that profit margins decreased due to regulatory changes, market conditions, and potential legislative changes in the industry. Additionally, there was a 5% decline in long-term gross margin, which directly contributed to the decrease in profit margins. The varying explanations for the change in net income and profit margins suggest that the company faced multiple challenges during this period. Regulatory changes and market fluctuations had a significant impact on the company's financial performance, leading to decreased profitability. The company's financial performance is a notable aspect of its overall health. According to the provided information, the company has consistently generated positive operating cash flow over the past 2 years. In 2025, the company reported an operating cash flow of $26,258, while in 2024 it was $25,178. This trend is also reflected in the operating cash flow summary on page 237, which states that all years show a positive operating cash flow. This indicates that the company has been able to generate sufficient funds from its operations to cover its expenses and invest in growth initiatives. The company's debt level has undergone significant changes over the past few years. While there have been instances of a decrease, such as a $162 million reduction from 2024 to 2025, page 17, and a total debt decrease from $6,164 million in 2024 to $5,943 million in 2025, page 169, other pages indicate an increase. For example, financial liabilities increased by 18% from 2024 to 2025, page 193. Additionally, the company's non-current liabilities increased by $851 million from 2024 to 2025, page 168. In terms of interest expenses, there have been both decreases and increases. For instance, interest expense charged to profit or loss decreased by 31.5% from 2024 to 2025, page 208. However, other pages indicate an increase in interest expenses, such as a $121.2 million increase from the previous year, page 177, and a $123,595 increase from the previous year, page 178. The company's total debt to total capital ratio increased by 0.8% from 2021 to 2025, page 238, indicating an overall increase in debt levels over this period. Furthermore, interest on borrowed capital increased by 14% from 2024 to 2025, page 243. The performance of various segments and regions within the company has been mixed. On a positive note, Pacific Basin Shipping Limited, Link Asset Management Limited, China, Growth Markets, Hong Kong, CLP China Business Unit, Renewable Energy Projects, and Digital Transformation have all shown strong performances. These well-performing segments have contributed significantly to the company's overall growth. On the other hand, India and Australia have struggled with poor performance. India has faced challenges in various areas, while Australia has specific issues related to regulatory compliance cases. These poorly performing regions require attention and improvement strategies to get back on track. Management is emphasizing the importance of sustainability and climate-related perspectives in business operations and strategic decisions. The company aims to support the development of carbon markets, including Hong Kong's ambition to become a leading global marketplace. To achieve this goal, management has implemented various strategies, such as transitioning to a net-zero GHG emissions business by mid-century through its Climate Vision 2050. This vision has informed and guided the company's business strategy since its launch in 2007. In addition, management is focused on minimizing financial risks, particularly exchange rate and interest rate risks, through hedging purposes using derivative financial instruments. The company also has a prudent approach to managing liquidity risk, with sufficient cash and committed credit facilities to meet future funding requirements. Furthermore, the company will have protection for stranded costs due to future market changes, and tariffs will be set based on operating costs and allowed net return. Overall, management strategy is centered around sustainability, climate-related perspectives, and minimizing financial risks to ensure a stable and environmentally friendly business operation. The company has a history of paying dividends. According to the provided information, the company has paid dividends in various years, with specific amounts mentioned for each year. In 2022, the company paid $10,000 in dividends, increasing to $11,171 in 2023 and $20,941 in 2024. The dividend payments continued in 2025, with a total of $7,958 million paid out. The company's dividend payments are not limited to a single year or amount. In fact, the information provided shows that the company has made multiple interim dividend payments in each year, with the amounts totaling millions of dollars. For example, in 2025, the first to third interim dividends totaled $4,775 million, while the fourth interim dividend was $3,310 million. Overall, the evidence suggests that the company has a consistent history of paying dividends, with significant amounts paid out each year. This indicates that the company is committed to returning value to its shareholders through dividend payments. Concerns about inventory buildup or supply chain disruption are evident in the provided summary. On page 173, it is explicitly stated that there are concerns about inventory buildup. Furthermore, on page 231, potential issues related to inventory buildup are highlighted due to unrealized losses of $12 million in 2025. Additionally, supply chain disruption is mentioned on page 238, where a shift from coal to renewables is noted, indicating a potential disruption in the supply chain. Geopolitical tensions also pose a risk to long-haul transportation of goods, page 46. Moreover, concerns about decommissioning costs for generation units at Castle Peak, A Station, page 209, suggest potential risks to the overall supply chain. These points collectively indicate that there are valid concerns regarding inventory buildup and supply chain disruption. That concludes the financial summary for CLP Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.